Hi everyone, I'm Paul and welcome to my review of Lesson 22 of ICT's 2022 Mentorship Program. In today's video, we're going to talk a little bit about tape reading and then introduce ICT's SMT divergence concept before we have a look at some trade examples on the S&P and on the NASDAQ. But before we do, if you enjoyed today's video, it would be great if you could like it because that helps other people to find it. And if you haven't already, make sure you subscribe to my channel and turn on notifications so that you never miss an update. These are quick, easy, and free ways for you to support my channel. Lastly, if you'd like to hear more from me and join a community of like-minded traders, then click on the link in the description and subscribe to my free weekly newsletter and to my Discord. Now that that's out of the way, let's jump into today's video. So today's video is lesson 22 of ICT's 2022 Mentorship Program. So just walking through the outline for today's video. First, we'll be speaking a little bit about tape reading before introducing the ICT SMT, that smart money technique divergence concept. And then we'll finish up with some trading concept examples using the S&P on the daily 1 hour, 5 minute down to the 1 minute from the 29th of April. And that's both the morning and afternoon sessions. And then we'll also run through some actual live executions by ICT on the NASDAQ using the 5 minute, the 1 minute, again from the 29th of April, and these are all from the pre-New York session. So first off, starting with tape reading. Now we're not going to go a lot into tape reading in this particular video because this is just something that builds throughout the ICT mentorship course. And so the easiest way to approach tape reading, and this is sort of how I try to do it, is just keep it as simple as possible and not really try to overcomplicate what you're doing. And so really the core tenet is, where is price going and why should it go there? And so what's our narrative wrapped around those sort of two questions? And so to make that easier, what I always think about is, where does the buy side and the sell side liquidity reside? And where will the smart money be buying? And where will the smart money be selling? And obviously the opposite would be true for a sell and a buy. And so if you try to restrict your framework to these sort of simple questions, I think you'll find tape reading is much easier. And then it just comes down to practicing this again and again, and just accepting that you're not going to get it right every time. You may get it wrong for quite a long time, but it's only through practice and repetition are you going to improve, and then you'll just start to see where you've made mistakes and be able to improve on that. But for me personally, I've just found keeping it to these specific questions, and especially when I think about where would smart money be buying and selling, or selling and buying, I found my tape reading improved dramatically. The next topic we want to introduce into today's video is ICT's SMT divergence, and SMT stands for smart money technique. And so what we're looking at here is a stack chart where we have the NASDAQ on the top and we have the S&P here on the bottom. And we're looking at the 5 minute chart, and we're just effectively looking at a range from about 2 o'clock in the morning to around 10 o'clock in the morning. And what you can see if we specifically look at the NASDAQ first is from this swing high here to this swing high here. You can see the highs at 10 o'clock actually eclipse the highs at 2 o'clock here. So we have a run on this liquidity here. So we have a run on these stops up here. But if we look at the same chart, so at the same time on the S&P, we actually don't get that. So what you see here is from, that 2 o'clock, that high there, that the run up at 10 o'clock is actually lower. So we don't get a run on the stops at 10 o'clock on the S&P like we did on the NASDAQ. And so what we have here is a divergence. So you can see the market has gone up on the NASDAQ and we've actually, trended down on the S&P. And so what that tells us is comparatively, the S&P is significantly weaker than the NASDAQ. So ICT's SMT divergence is just another tool similar to how we would use correlation between different assets, and in this case we're using the divergence between assets which have a high correlation to each other to add an additional tool to create confluence in our trading. Switching over now to the first of our trading examples, we're looking at the S&P 500 or the ES on the 29th of April, and we're specifically looking at the daily chart. Now, we've been looking at this chart for quite a while, obviously, and the area of interest that we've been talking about is this area here where we have these relative equal lows, this sell side liquidity. And we can see from that zone, the market's rallied higher. We took out this buy side liquidity, these relative equal highs here, before we started to consolidate. And then the specific area we're looking at is then this order block, this bearish order block just here. So we can see this is an up close candle before we have this displacement. So we have this small fair value gap just in there. And you can see then price has then gravitated down towards these relative equal lows down here, this sell side liquidity. So this area has acted like a magnet, and this is what we were expecting. And this is obviously drawing into the seasonality concept as well, because we're running into May, which we would seasonally expect to be, a down period. So this is that whole period that we're talking about, and we're going to start zooming in to this particular area here on the 1 hour chart. So zooming in now to our 1 hour chart, basically what we can see is that from the previous day, so from the 28th, you can see that the market has rallied, really strongly, and it's come out and it hasn't quite taken out this buy side liquidity up here. It's basically just touched it before then selling off. So you can see we've sold off, and then in this candle here, so we get this displacement, and the market actually gaps. And so you can see the difference between the low of this candle and then the high of this candle becomes a bearish fair value gap. You can see if we extend that across from the 28th and then into the 29th, so remember we're on an hourly chart here, you can just see how once the market trades up into that fair value gap, it then trades really neatly within it. It obviously wicks in and out, but the bodies of these candles largely respect that fair value gap. You can see we drop into it as we come into the early part of the 29th, and then as the market opens, it trades back up into that zone, and you can clearly see the reaction we get from that fair value gap. And then that sell side liquidity, these relative equal lows that we marked out on our daily chart, become that strong magnet for price. And you can see from the open, the market just trades down very strongly towards those relative equal lows for the rest of the session. So we've zoomed in now to the 15-minute chart here on the 29th. Now there's quite a bit going on, so I'll just orientate ourselves on the chart before we start going in to the details. So we have these relative equal lows, this sell side liquidity down here from the daily chart. So we've transposed that from the daily to the hour to now to the 15-minute chart. And this is our fair value gap that we marked out. So remember we had that gap on that 1 hour chart, which we've drawn across. Now, this is our 8:30 open, so it's the first of the opens that ICT uses. So you can see that at the open here, so at the top of this down close candle. I've just extended that across. And then we have the equities market open here at 9:30, and again, I've just extended that across. Now, there's actually two opportunities to get set in this particular session. The one that ICT outlines is obviously we have the hourly set up here on this fair value gap. So after the market opens at 8:30, you can see we sell off. We then take out this buy side liquidity before coming back up into this bearish fair value gap on the hourly, and then we sell off here. So if you're using that hourly, you could have easily entered in this zone here and then obviously traded to the downside, and that would have been a great trade unto itself. And so the first of the setups that we'll look at is on the 15-minute chart is this fair value gap up here, which I just noticed as I was setting up just before. So you can see if I mark that out now, just mark that up as a bearish fair value gap just there. You can see this is our fair value gap formation here. So 1, 2, 3 candle formation, and we've actually got a gap here. So it's between the low of that first candle and the high of that third candle. And you can see this fair value gap is confluent with that fair value gap that we had on the hourly, which is also, that gap on the hourly as well. So you can see that's confluent with that fair value gap, and it's kind of nested, if you like. So we have these overlapping fair value gaps, which would tell us that this should be an area of strong interest to us. And so the market after that 8:30 open, you can see we trade lower. We then come and take out this buy side liquidity. So we have these relative equal highs here. We trade up into that confluent zone, those overlapping fair value gaps just there, and then we immediately start to trade lower. And you can see if we'd had our setup here, I'll just put that in here like this and mark that out. So if we'd use that high here and still targeted the same sell side liquidity there, you can see we would have got a nice 3R return off that particular trade just there. Now, the second trade that we go through, and this is the one that ICT goes through in the actual lesson itself, is post the open. So you can see just the same setup as we just talked about before. We have at 8:30 open, the market starts to trail off. We then punch back up into that fair value gap. We get a reaction there, and then the market sells off heavily. And you can see we get that big displacement. So we have our fair value gap form just here. So 1, 2, 3 candle formation with our bearish fair value gap forming between the low of that first candle and the high of this third candle here. And we obviously have our market open there. And in the process of this displacement, this big move downwards, we actually break market structure here, and this is our swing low that we break here. And importantly, this swing low you can see is basically before we take out this liquidity on the buy side. Now, ICT doesn't talk about this specifically, but what I've noticed is that when you have your swing low prior to the liquidity grab, and that's broken, that's your break of market structure, that seems to be a much more powerful indicator than if you have the liquidity grab and then the break in market structure afterwards, if that makes sense. Even so, you can see on this particular setup, we then trade back up into this fair value gap. So remember, this is on the 15-minute chart before we then trade towards that target, which is this sell side liquidity relative equal lows down here. Now, if we'd taken that trade on the 15-minute chart, you can see we would have got an easy 2R return, and that is quite a simple setup, and that's obviously what we've practiced throughout the 2022 mentorship program. So still on our S&P trade, but now we've zoomed in to the 5-minute chart, and what we're looking at is this particular area of interest just here. So this is at market open, and so this is that area that we're looking at on both the hour and the 15-minute chart. So this is the 8:30 open where the market's rallied above these relative equal highs. It's painted this swing high here before selling off. So we're just going to drill down into this particular area here on the 1-minute chart and have a look at some of the setups that we could have taken in terms of taking advantage of this particular move in the morning session. So we're on our 1-minute chart now, and so this is our 8:30 open just here drawn across, and you can see the market's traded under that and then above before selling off. And so if we just mark out some of our details from the higher time frame chart, so these are the relative equal highs that we took out after that 8:30 and then the 9:30 open up here. So we've taken that buy side liquidity before selling off here. Now, it's not easy to see, but there is actually a fair value gap just here. It's very small, but it is there. And we also have a swing low just here. And so that's our break in market structure just there. So normally I like to see that break in market structure of that swing low prior to the liquidity grab, but ICT teaches it also afterwards, and so that's the case in this example. So you can see we took the liquidity, we created these relative equal highs, sold off after that 9:30 open. We've then come and taken out these relative equal highs, buy side liquidity here, painted this swing high and then sold off. We've just had our displacement just here, created that fair value gap, and you can see that the market's traded up into it those 2 times. And where you would have your stop in this example, just make this a different color to make it easy to see, just depends on your risk tolerance. So you can see our fair value gap model is our 3 candle formation. So 1, 2, 3. By the rules of that, you could have your stop just here on the high of that first candle. That's obviously going to be pretty close, and you can see you would have come quite close to getting stopped out if you'd done that. But certainly more conservative approaches would be using this swing high just here, and obviously even more conservative would be using the high that we took that liquidity out just here. So you would be going short on the high of that third candle just there, and as I said, have your stop either on one of these 3 places just there, and your target would be those relative equal lows, the sell side liquidity that we marked out on those higher time frame charts. You can see that would have been a really great trade. And obviously if you're just looking to pick up that low hanging fruit that ICT talks about often in his videos, is that you would be targeting an exit down here at the swing low here or potentially down here, or you'd potentially take some partials at this level and then leave the rest to run if this was in line with your bias. And obviously going into this particular session, we did have a bearish bias, so it wouldn't hurt to have a few contracts open or some portion of your trade open to run and see if you can pick up some additional profits on that particular setup. And so moving on to our afternoon session now, and you'll remember that our afternoon session starts after 1:30, so we have lunch from 12 till about 1:30, so you shouldn't be taking any trades in this particular part of the session according to ICT's model. Now in this instance, because we have a bearish bias and you can see the market has been trading lower across the course of the whole session, our expectation is that we would rally as we come out of that lunch session, and you can see that's exactly what happened here. And so if we look to our left, you can see we had this big displacement down. We had these two fair value gaps that were painted in that process. And so if we just mark out our fair value gap here, you can see after 1:30, we trade back up into that zone before then selling off as we attack this sell side liquidity relative equal lows down here. Now, obviously when you set up this particular trade, you would be taking your limit sell order here at the high of that third candle, but you would need to have your risk set so that you could take price going up into this additional fair value gap here. So you can see there is one slightly higher than that, and so you would need to have your stop either set at this level here so that you could accommodate price going up into that additional fair value gap, or a more conservative approach would be to have your stop at that swing high just there. So again, that's a personal preference and just comes down to what you've tested and what you're comfortable with. Now there's a number of other opportunities to get set in this afternoon session, and we're just going to look at the 5-minute chart and just highlight some of those. And this is again just using the same model that we've used throughout the mentorship model, which is the fair value gap. So you can see in this particular move here, we have a big sell-off and then the market runs back up. We've got these small gaps and so on here. So we get that retake of buy-side liquidity, if you want to call it that there, and we get then a small run down and then a fair value gaps formed there. You can see there's another opportunity to get set in that movement. And then similarly again, we have another displacement down which creates that fair value gap. And that again gives us another opportunity to get set and target that sell side liquidity relative equal lows down here. So not only in the morning part of the session was there an opportunity to take advantage of this move, but we then had one straight after lunch and then a number of other opportunities after that one at lunch to get set and take advantage of this move. So this is one of those days that you don't get too often, where there's lots of opportunities like this. The market is omnidirectional and it just gravitates towards that particular price, and is a chance to really pull a lot of profit out of the market. And so the last trade example we're going to look at is some trades on the NASDAQ from the pre-New York session that ICT shared on the lesson 22 video. And so you can see the executions, these little red arrows here. Now if you look at the screen looking at that, it's a little bit confusing as to why he's taken those particular trades there, but if we unpack it a little bit, it starts to make more sense. Now if we think about this particular piece of price action according to the model that ICT has been teaching in the 2022 mentorship, you can see we have this liquidity up here that was taken. So we have a swing high here, the liquidity was taken to the upside. So you can see, even if we just mark out this most recent move just here, you can see this liquidity is taken here. We trade higher, then we immediately get our displacement lower, and we've got our swing low here, or you could even use this as your swing low, which breaks market structure just there. And then we obviously get a number of fair value gaps in this displacement lower just here. So if we mark those out, they'll be quite apparent. So we have one here, we have one just here as well. Now in this particular move, if we sort of take our fib and run it from here to here, we'd be wanting to take a short trade obviously in a premium market, and so we'd be looking at any fair value gaps above that 50% level. So that would include this one, and then obviously this one would be too low, that would still be in a discount. Now, ICT teaches in his mentorship to take this first fair value gap, but to be able to accommodate in terms of your risk, price trading up into this second one. So you can see if you'd taken trades here, so you would have had your limit to sell at the high of this third candle here, you would need to have had your stop either at one of these levels up here. Let's mark these in green. So you'd need to have a stop either here or potentially up here, or even if you wanted to be super conservative, is up here. But you can see price has only just wicked into this one, and this kind of displays why you don't want to be greedy and going for this fair value gap in terms of your entry. Whilst it might be a stellar entry and you get a really great price and you get to capture more of the move, the flip side of that is that it's not always going to do this. It's not always going to wick into this particular level, and so this is a great move. And as we talked about on the S&P, there was lots of opportunities to pick up a lot of profit from the market. But if this was the only trade that you attempted in the day, by being a little bit too greedy, you've missed out on the entire move, and that's obviously the opportunity to pull out a high risk reward trade. And so that's why we're much better off taking the trade in this zone and just having our risk set high enough to accommodate a move into this zone, and that's what we've done. Now, obviously, that's how the model works in terms of the mentorship, but the executions are obviously down here. And so the thing we want to think about before we go down to our 1 minute chart and start to look at the more granular price action and start to talk about why ICT took the trades in this zone here, we just want to look at these three swing highs that we have here. So we have one here, we have one here, and we have one here. Actually, what I'll do is I'll clean all this off and we'll do this again. So we have a swing high here, we have one here, and then we have one here. Now, each of these swing highs has an imbalance in it. So this one has one here and one there. This one has one here and one here. And this one has one just here. So all three of these swing highs have an imbalance. And so by ICT's definition, that makes each of them an intermediate term high. So this is an intermediate term high, this one's an intermediate term high, and this one's an intermediate term high. But remember, the hierarchy we have is we have an intermediate high with an intermediate high each side of it, like we have here. That makes this a long-term high. And so judging by this particular price action, we would expect that this high is definitely not going to be broken, and this one is unlikely to be broken. So we now have a long-term high with an intermediate term high to the right of it. So we'd expect that the market is going to fall from here. And so that's why, or one of the reasons why ICT was comfortable in starting to take trades down at this level, even though it would feel like the bulk of the move has actually already happened. So as we zoom into our 1 minute chart now, it becomes more obvious why ICT took these particular trades. So you can see we have a bearish order block just here, and that's where the bulk of the executions were. Now, it's important to note that ICT pyramids into his position. So in this particular example, on this red arrow here, he took 3 contracts, 2 contracts, and then 1 contract on this particular one. And so the reason why he does this is that he takes the bulk of the position at the initial point of entry and then adds to that as the position starts to go into his favor. So as you can see from this particular trade here, he had 3 here. By the time he took the second trade, which was 2 contracts, these 3 contracts were already in profit. And then again, by the time he took this particular trade, these 5 contracts were all in profit. So even though the market started to go against him a little bit here, it's only this 1 contract that is then, taking a little bit of heat, where all of these are already deeply in profit. And so the position itself in its entirety is already in profit, and that gives him then a lot of buffer to then where any particular movement, like you have just here, before he reaches his target. So that's an important thing to remember. As you can see, when he's exited here, he's just taken all 6 off the table at the one time. Now, if we go back to the actual reason for his entering these positions, as I mentioned before, we have this bearish order block here. So this is the up close candle before we get this down move. So this displacement down has a fair value gap in it, so that's what we need to see. We have this up close candle, we have this down close candle and displacement with a fair value gap inside it, so that makes this our bearish order block, and you can see he takes executions within that. And this last one here, as the market trades back up into it, you can see we actually have, part of the mentorship model there. I'll just make this in pink. You can see we have a bearish fair value gap there. We actually have them here as well. So there was lots of ways to actually get set in this particular, segment of the market, if you want to call it that, in terms of picking up this move. So there was lots of opportunities here. There's obviously fair value gaps up in this particular part of the movement as well. So there's lots of confluence in this area in terms of ICT's model and the setups that he teaches. So lots of reasons to get set in here and take advantage of that move. As I said, ICT exited all 6 of those contracts down here for a tidy profit. Thanks for watching my review of lesson 22 of ICT's 2022 mentorship on YouTube. I hope that you found today's video helpful and it helped to consolidate some of the concepts for you from ICT's teachings. If you did, it would be great if you could give the video a like, because that will help other people to find it. And if you haven't already, make sure you subscribe to my channel and turn on notifications so that you never miss an update. And as I said at the beginning of the video, if you'd like to hear more from me and if you'd like to join a community of traders who are on a similar path probably to you, then check out the link in the description for access to my free Discord and my free weekly newsletter. Thanks for watching, and I hope to see you next time.